The June quarter saw the portfolio deliver a solid return. From the AREITs, we saw several March quarter updates, and they were very encouraging. While later in the quarter, as we approached the 30th of June, a number of the AREITs provided valuation updates as they get to the end of their financial year, which were also encouraging. Moving across to the bond market and what we saw there, which is of course relevant for REITs in terms of how we think of REITs in a valuation context, 10-year nominal bonds rallied from about 4.4% to just under 4.2% over the quarter, while the 10-year inflation-linked bond, we refer to as real bond yields, rallied from 2.3% to 2.1%, and that is where we focus most of our attention. We also saw the second interest rate cut, bringing the cash rate down now to 3.85%. And of course, we have expectations of further cuts from here. Now, they're also supportive for REITs in terms of the earnings trajectory for them as the interest rate cuts come into play. Now, in terms of the drivers of performance over the quarter, they were from GPT Group. That is actually our largest holding at the moment. Aspen Group, one of our smaller holdings, it's had stellar performance. In fact, its return over the last 12 months has been in excess of 100%. And finally, Stockland, also a large contributor. While the detractors were overwhelmingly from one security being Dexus Property Group, and to a very small degree Australian Unity Office Fund, which is essentially in a wind up, and we've now exited our position there. Moving on firstly to the contributors, GPT Group. Now this is a very high quality diversified group. It also has a funds management to its business, and that has had very positive trajectory. They set up a retail partnership with Perrin, a number of new management mandates, and subsequently a new $1 billion Australian logistics partnership where they made a 20% co-investment. So that's quite positive in terms of GPT Group. Now, Aspen Group, I mentioned that earlier, they hosted an investor tour. They also undertook an expansion capital raising, and following which it is a larger group, but it brought more investors onto the register, which creates more turnover and liquidity. And what that is quite likely of seeing is index inclusion in terms of the major AREIT indices, and that is a potential positive there as well. Now, Stockland Group, I mentioned that earlier, they are a large diversified group. Of course, many people know them for their residential part of the business, where they are Australia's largest subdivider or creator of communities, and they provided a March update, and that showed very resilient residential demand. It did show some underperformance, I'd have to say, in the land lease communities. However, working through all that, they reaffirmed their FFO guidance for FY25. And of course, from a macro perspective, the most interest rate cut is also a positive. Now, in terms of our detractors, our largest detractor was Dexus Property Group. They are primarily an office REIT. They do have industrial, and they also have a funds management business as well. Now, the office markets are coming off the lows, and we're actually seeing some positive movement there. In fact, their valuations for Dexus went up, and that's notwithstanding the capital rate expansion. So we're seeing some positive read-through there. But what has weighed on Dexus over the quarter has been their funds management business, where unfortunately they've had a couple of unfortunate events for them. The main one to do with their investment or their clients' investments in an airport fund. And it's a bit long to go into that in terms of this audio recording, but what we did there is we actually reduced our position in Dexus Property Group subsequent to that when we saw that, and we used that as an opportunity to reinvest into GPT Group, which has actually had positive initiatives on the funds management piece, and I mentioned before, high quality group and attractive valuation. Now that moves us into the portfolio and the positioning and any changes that we may have had. What I would say first about the SGH Property Income Fund is we are focused on investing in high quality real estate at attractive valuations for income. As you expect, there wouldn't be a lot of change over a quarter. We're investing for the medium to longer term. We aim to have the portfolio well diversified. We can't have any individual holding above 15%. And that is in significant contrast to the AREIT index itself, where one holding is currently representing around 40% of that index. What we've been doing with the portfolio is we've actually found with the market that a number of the larger REITs have been doing particularly well. They've been becoming more expensive, and we've been seeing that as an opportunity to, if you like, sell down out of some of those positions and reinvest into some of the smaller entities, which also has the benefit of investing in less economically sensitive sectors, more value, and more diversification. And where we've been doing that, for example, has been in centre group and vicinity centres. I mentioned that in the last quarter, but we've continued on with that. But also during the quarter, we added to GPT group. I mentioned before about reducing on Dexus, so that was one move there to assist with increasing our GPT group positioning. We added to our position in Growth Point Australia. We introduced that in the portfolio in the previous quarter, but we've continued to add there. We've added into Centurion Industrial. We have added a new security into our portfolio this quarter, and that is Cromwell Group. Now, this is a group that we've been watching for many years. It's a group that's had its many challenges. It had a large funds management business, primarily in Europe, that was not doing well at all. It had a lot of gearing and a very poor balance sheet. Now, as you can imagine, given it did have its challenge, its security price fell over that period of time. But what they've actually done is they've wound down their funds management business and effectively exited that European funds management business. They've significantly reduced their leverage such that now its gearing is actually below the sector gearing or in line with the sector gearing. So that's attractive, a good balance sheet there. And of course, with the security price coming down, there's an attractive valuation. And what we actually found during the quarter, that a larger security holder was selling down its position, and that created a liquidity event for us to get in there at a discount. Hence, we added to our portfolio and we continued to add to our portfolio. Now, putting this together, reasons to invest in the SGH Property Income Fund. Firstly, what I'd have to say is Australian property in itself is an attractive asset class, and it is given our robust population growth, which is really the envy of the world. Now, on top of that robust population growth, there's very limited supply. In Australia, we have very stringent planning. It is just harder to get things done and bring new supply. But on top of that, the construction costs have elevated up considerably in recent years, and that just makes the economics challenging. We're seeing several REITs trading at discounts to the direct market. And what I mean by the direct market is you think of where buildings, whether it's an office building, a shopping centre, an industrial building, even a house for that matter, is selling in the real world. That's essentially valuations. Now, REITs are in the public world of the ASX, and they're trading at a discount to that in many cases, and that's attractive. The portfolio is very well positioned, and it's a very resilient portfolio. We saw that particularly during the month of April, when we had all the noise around tariffs and the equity market fell considerably, the AREIT sector fell considerably, and this portfolio held up very well and actually continued to grow. Having said that, the portfolio is trading at a discount of about 8% to its net tangible asset backing. That's the value of its real estate. And if you use our lens of looking through the cycle of the value of the real estate, plus adding on the value of the businesses which aren't just bricks and mortar real estate, if you like, things like funds management, it's at about a 15% discount. As I mentioned before, we've had interest rate cuts. We've had 2 so far, but we expect them to be more meaningful. And if they manifest, that provides an earnings tailwind going forward. And the valuation is also attractive. The portfolio is well diversified. It's delivering a solid income yield. We just finished off the June year, and the income yield has been very solid. And the valuations that we're seeing from the REITs, and we're going to see more through reporting season, have been very positive. Even in office, which has its challenges, we're seeing valuations stabilising, in some cases moving upwards. So pulling that all together, we feel quite constructive about the outlook for the portfolio from here. In terms of our expectations for the next quarter, well, in a world where there are policy changes, it feels like almost daily. I just look at tariffs and what's been happening there. You feel like if you're just looking at that, you're really jumping at shadows. That's not how we invest. We're not really focused on the short term and the noise. We prefer to focus on the longer term, and ultimately, valuation is what matters. However, as we move into the next month, we are moving into reporting season. And what we expect to see there is not a lot of changes. We expect to see some evidence of solid or improving occupancy, which is good. The valuation movements, we've had a little bit of insight there, and we expect to see more, which is also likely to be a positive, and a more favourable interest rate environment. This should all be supportive through the medium term. So essentially, we're looking for the medium-term outlook quite favourably for the portfolio from here. Thanks for listening.
This fund update has been prepared by SG Hiscock & Company to provide general information only and is not intended to take the place of professional advice and it does not take into account the investment objectives, financial situation, or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.